Welcome again to our pensions and income tax session this evening. For anybody who missed it, what we're going to try and do is talk about the different types of pension scheme, how we get tax relief on our pension savings, then looking at the thresholds for income tax and how that could apply to our pension and income. And we've also got some examples and frequently asked questions to cover at the end as well. I do need to give you a warning. Okay, we are not tax advisors. Okay, we are specialists in public sector pensions, so we have some knowledge about how tax applies to our pension and pension benefits. And all I'm trying to do in this session is bring some of that awareness to you. So we're going to look at a basic introduction to income tax and some of the core principles. If you are somebody who has very complicated tax affairs, so multiple sources of income, things like that, you might need additional professional support from an accountant or a tax advisor. Most people fall into the fairly straightforward bracket, but I just want to flag it's not necessarily going to cover everything you ever need to know. It's just about trying to give you some awareness and then some idea of where you can get more information. So we're not providing any advice, financial, tax or otherwise as part of this session, and you must take the time to make sure you understand your own position. Okay, perfect. Right, are we good to go? Right, so let's look at types of pension scheme. If you've been on any of my sessions before, you probably will have heard this already, but let's do it again anyway. In the UK, we've got two different types of pension scheme. So if you imagine pension scheme as an umbrella, and then it's split into two different categories, which are DB or defined benefit and DC or defined contribution. Okay, so both are pension schemes, but both work very differently to each other. And really, we shouldn't try too hard to compare the two because they are completely different things. Defined benefit schemes are schemes that provide an annual income for life, and that annual income is calculated by a formula or formulas. Okay, and the formulas usually circle around salary and service and things like that. And so what that would do is provide us an annual income like a salary for when we stop work. Okay. Defined contribution schemes, or the DC schemes, are really different. They are more of an investment option. So contributions are paid in, they are invested, and they build up as a pot or as a fund. And then the value of that can fluctuate. It can, of course, go up or down depending on what's happening to investment returns because it's invested. They are very flexible to access, but you don't get a guaranteed income for life necessarily for when you stop work. You have a fund or a pot of money and you have to make various decisions about that. Now, you all should be, if you've come through Facebook in particular, a public sector pension scheme member. So that means that as a public sector pension scheme member, whether that is NHS, teachers, civil service, police, fire, and so on, your benefits are defined benefit because you should be aware that your pension benefit is going to be an annual income for life for when you stop work. Okay. And it's a guaranteed income that increases by inflation. So if you, for example, you have your pension statement and your pension statement says you're going to get £10,000, that's £10,000 paid to you every single year that you're alive in retirement. And actually it would be more than that because it would increase each year by inflation. Okay. Now, if we then imagine that defined benefit is an umbrella, what then sits under that umbrella is two types of different pension scheme. They're similar, but they're a little bit different. They are final salary and care or career average revalued earnings. So does anybody want to pop in the chat what might be an example of a final salary scheme and what might be an example of the care or the career average scheme? While you're doing that, I'll talk a bit more. The final salary schemes use your pensionable service. So that is the length of time you've been in that section for, pro rata for any part-time working, and it links to your current full-time equivalent pay. So as your pay goes up, those whole benefits are recalculated and they increase. The care scheme or career average scheme uses pensionable pay each year, an actual pensionable pay. So we would calculate your pension based on your pay in year one. We would then calculate your pension based on your pay in year two, and then we add them together. We would calculate your pension based on your pay in year three, and then we add them together and so on. And that's how it becomes what's known as career average, because the pension builds up as a proportion of your average pay for your time in that scheme. Very good, everyone. So we've got some examples of final salary. We've got NHS 1995, NHS 2008, NHS 2015, yeah, and 2015 scheme, exactly that. So a lot of you will know that you've probably got two parts to your pension now. You've probably got final salary and you've got a career average, okay? So that's how it works. So they all come under those umbrellas. Now, the only reason I'm mentioning that is because when we start looking in a minute at the tax release, it works a little bit differently depending on whether it's a defined benefit scheme or a defined contribution scheme. Okay. Has anybody got any questions at this point? So let's look at pensions and tax relief. So you may or may not know this. Some people do, some people don't. You will be aware, or you should be aware, that in order to be a member of your pension scheme, whichever one that is, you have to pay a contribution. And that contribution is deducted directly from your pay. And it's a percentage that you pay. And usually that percentage depends on how much you earn and also which of the public sector pension schemes you're in. But if you look at your payslip, you'll be able to see what that is. So you pay contributions and your employer pays contributions. You receive tax relief on those contributions that you pay in. So your employer contributions are just paid across and there's no tax for you to pay on those. And your contributions are deducted directly from your pay before income tax is calculated, which means you get tax relief on those as well. So one of the reasons people like saving into a pension is because it's an incredibly tax efficient way to save. Does anybody know how much roughly their employer contributes into the pension scheme for them? And again, this varies from the schemes, from scheme to scheme. So civil service is different to NHS, for example, but they're all kind of in the same sort of ballpark. Does anybody know? 23%, says Karen. Good guess, because I can see where you work. Anybody else? No? Okay. So for NHS, it's 23.7%. It's nearly 24. That's right, Carol. For the civil service, it's about 28%. Local government, it varies depending on the fund. It can be between 20 and 28%. They're all very high percentages that the employer pays in. So that's like in addition to your pay, but you don't pay any tax on it. It goes into the scheme. So that's really good. Now, on this slide here, I've got an example of tax relief. I don't generally like slides with lots of words on them, but sometimes, particularly where you're going to take these away to look at later, they can be quite helpful. So as we've said, your contributions are taken from your pay before your income tax is calculated. So that means that you receive income tax relief on those contributions. How much income tax relief depends on what tax bracket you're in. So we've got two examples here for you to look at. So if you're a basic rate taxpayer, that means you pay 20% tax. We're going to look at the tax thresholds in a minute. If your annual salary is £30,000 and your contribution rate is 8.3%, 8.3% of 30,000 split down to a monthly contribution is £207.50 per month. But they take that off your pay before they calculate your income tax, which is how you get tax relief. So the actual reduction that you will see in your take-home pay is £166. Does that make sense? So you get that tax relief. If you're a higher rate taxpayer, that means you pay 40% tax. So for this person, their salary is £60,000 a year. So that puts them in that higher bracket. Your contribution rate is 12.5%. When we work out how much that would be per month, that would be a deduction of £625 from your pay. But because it's taken off before we calculate the income tax, you actually only pay out of your net pay £375. So can you see that? Can you see how much tax relief you get on the contributions that you pay in? And that's why, again, it's a really important and valuable benefit, because it's not actually costing us £207 or £625. It's actually costing us £166 or £375. So you're getting that tax relief up front, which is important because when we talk about tax later, sometimes people feel quite aggrieved that they pay tax on their pension, but you've had it tax-free up to this point. So that's why it's important. You should also check your pay slips to check that you are actually paying the right contribution. So if you're not sure, you can Google your pension scheme. So if you're in the NHS, you can Google NHS pension scheme contribution rates, and it brings up a table and it will tell you the percentage of contributions that should be paid depending on what your income is. And you can check that your payroll is deducting the right percentage. So we get tax relief on our pension contributions, we get tax relief on our employer contributions, and then the pension grows each year. And we get tax relief on that as well, up to a point. We'll talk about that. But generally we get tax relief on however much our pension is increasing by, because remember our pension is that annual income. So every year for being in the scheme, it's going to grow, isn't it? And we get tax relief on that as well. And then when we come to take the benefits, the lump sum from these public sector schemes is tax-free up to £268,275. So long as your total lifetime pension lump sums from all your pension schemes are not more than £268,275, they will be tax-free. HMRC won't allow you as well to have more than 25% of your benefits as a tax-free lump sum. So when you get a pension quote or an estimate, or you look at the modeler, it tells you the maximum lump sum that the scheme will pay. That keeps you within that 25%. Okay, it's a special calculation we have to do for schemes like this. So long as within that 25%, your lump sum doesn't exceed £268,275, then it is tax-free. Okay? So tax relief on contributions going in, yours and the employer's, lump sum, tax-free. This is good, isn't it? When you then receive your pension, so your pension is your annual income, which is paid to you monthly, very much like a salary. Pension income, HMRC treat as taxable income, and therefore your annual pension income is assessed for income tax, and you may or may not pay income tax on that pension depending on your overall income, but it is taxable income. Okay, so that's where the tax starts to come in. Now there are limits to how much you can pay into a pension and how much your pension grows by to retain that tax relief. That's called the annual allowance. I'm not talking about that on this session because this session is very much about the income tax impact. We do have other sessions and information out there about the annual allowance. Okay, so we're just focusing on income tax today. Has anyone got any questions at this point about the tax relief on contributions or the benefits? No, are we okay? All with me so far? It's very early days. You're going to need to lie down by the time we finish. Perfect. Okay. Right. So let's talk about tax thresholds then. So how does income tax work? So we know now, don't we? Our lump sum is tax-free, pretty much for most of us. The pension is taxable income, so it's got to be assessed for income tax, a bit like our salary is. So how does that work? How do they calculate income tax? What do we need to do? And then how do we plan this with our pension? That's really what we're looking at. The total pension benefit. So just coming back to Claire's question here, where it says the total pension benefit. Yes. So when we calculate your maximum lump sum that you can have from your pension scheme, it's something called the capital value, and the capital value is the value of all of the benefits. So we put effectively a cash value on the pension income and the lump sum, and we calculate 25% of that. So that's why it says total pension benefits, because it's all of the pension benefits. Hello, Robbie. If you have a private DC pension and NHS pension, could there be an issue if 25% of DC and 25% of NHS exceeds 268k? Yes, exactly that. So Remember what we've said here is that your lifetime lump sum, so the amount of pension lump sum you receive in your lifetime from all sources, cannot be more than £268,275. If you've only got your NHS pension, that's quite easy to work out, isn't it? But if, like Robbie's saying, we've got different pension pots and we've got different ways of accessing it, if your lump sum that you take is going to put you over £268,275, you will pay tax on the excess, because the 268,275 is the cap on how much you can have tax free. So if you go over that, you're going to have to pay tax on the excess. So you still get 268,275 tax free, but if you go over it, then you'll pay tax on the bit that's over, and only that bit. But what they will do, they being HMRC, is they will add it to any other income that is taxable that you've had in the tax year, and that will determine the percentage of tax you will pay. So if you're a higher rate taxpayer, they will add it to your income and they will say, well, we're going to tax it at 40%, for example. You're likely to be a high rate taxpayer if you're going over the 268s, but not always. Yeah, your marginal rate, that's right, Robbie. So that's often referred to as the marginal rate. So your marginal rate is the rate of tax that you pay. And that differs, it can be, we're going to look at this in a second, that can be 20%, 40%, 45%. Okay. So whatever your, or the applicable marginal rate is, that is what you will pay. Okay. So that when we're saying total pension benefits can't be more than 268,275, well, it can, but you'll end up paying tax on the bit that's over. So that's one of the decision points at retirement, if that affects you. Okay. So let's move on to tax thresholds. Okay. So we have what we call in our country something called PAYE. Have you all heard of PAYE? Yeah, okay. Did we all know it stood for pay as you earn? Okay, so pay as you earn, believe it or not, because I know everybody will have had a bad experience with HMRC at some point. Believe it or not, our tax system is the envy of many, many countries. Okay, pay as you expire. And the reason for that is because we don't generally have to do anything. So again, this is for most of us who have one job or even two jobs, right? Who don't have very complicated tax affairs. We don't do anything. It all gets done for us at our employment side. So our employer calculates and pays the tax. That's where we get the pay as you earn from. Okay, we don't get involved in it. Okay, there are not many countries in the world that have that sort of system. Lots of countries require people to do an annual return for their income and calculate and pay their own taxes. Okay, so the ones that don't are us, Singapore, Denmark, Sweden, Norway, Finland. Other countries, I'll rattle some off. You know, there's lots of countries in the world. United States, Canada, Australia, New Zealand, Germany, France, Italy, Spain, Netherlands, Japan, China, India, all have to do self-assessments. Okay, so we've actually got quite a sophisticated system, and it is envied by quite a lot of countries, as I say, believe it or not. The problem with that, though, is it makes us really lazy when it comes to tax, because we don't get involved because we don't need to. So why would we? And then we start having problems trying to understand it later on when we're looking at the implications it might have for things like taking a pension and salary. So if you can, try and get to grips with it a bit more, just so you got some basic understanding. Obviously, we're going to cover some of that now. But yeah, believe it or not, there's not many countries that have the system in place that we do, which is great. It's very efficient for us. But as I say, it also means that we kind of pull back a bit when it comes to looking at tax. We don't really want to get involved because we don't need to, do we? So the way that we look at tax is in a tax year. Now, I'm sure you all know this, but there's a reason I'm talking about it. So a tax year, for some reason, still runs from the 6th of April to the 5th of April. So that is the year that HMRC will assess your income to determine how much tax you pay. Okay, so we're 6th of April to 5th of April. Your income is assessed across a whole tax year. So what I mean by this is, for example, if I worked 6 months of the year, and in that 6 months, I earned £30,000. And then I stopped work and I got a lower paid job on £20,000, I might think that, so to say £25,000, I might think I'm going to pay 20% tax on all of that second job, but I wouldn't, because what they're going to do is they're going to look at my two incomes together across the tax year. So we look at the total income someone's had in a tax year, even where they change. Okay, so that's why the tax year is important. And HMRC uses a system of tax codes to determine the rate of tax that someone will pay. So when you look at your payslip, you'll see a tax code. Most people will probably have a tax code of 1257L. Come to that in a second. If you've got two sources of income, you might find that you've got a T or an X. You might also sometimes have BR, which is basic rate. Now, if you don't understand the tax code, that's okay. I can't tell you off the top of my head what a lot of the tax codes are, but what you can do is use Google. So if you don't know what your tax code is, you can Google it, and Google will explain or direct you to the HMRC website where it explains what the tax code is telling you. I recommend you do check your tax codes, because has anybody ever been in the position where HMRC has written to them and gone, oh, you've underpaid income tax, we'd like £3,000, please? Or perhaps they've gone a slightly better way of, well, actually, you've overpaid tax, so we owe you a refund. Has anybody ever had that happen to them? Of course we have, right? And the reason for that is because HMRC set a tax code or tax codes, depending on how many incomes you've got. Yeah, Robbie, they are very keen to take it off you and less keen to give it back. It is true. The thing about knowing what your tax code is that they need to know what your employer, what your income is. So they need someone to tell them. Okay, so that's normally your employer or your pension scheme or whoever is paying you liaises with HMRC, and HMRC then look at their records and say, right, okay, well, Laura needs to be on 1257L because that's going to be her tax code, and then they contact my employer, which just so happens to be me, and says this is what the tax code needs to be, and then the employer updates the system and the tax is all magically calculated. Now, if the employer doesn't tell them the right pay, or something changes mid-year, that can result in under or overpayments because HMRC need a bit of time to catch up. It's not unreasonable. They can't suddenly instantly act on everything. So we need to make sure that we're on top of it. So you can either wait and get your refund, because sometimes that's quite nice. It's always a bit distressing when they go, now you owe us some more money. But what you can do, which Magda has mentioned, is use the HMRC app. And I'm going to show you that a bit later on. But the HMRC app is incredible. It's still fairly new. I mean, it's been around a few years, but really it's become into its own the last couple of years or so. So you download the HMRC app, you log in with your .gov gateway, and then if you're like me and you don't like putting in the number that's about 1 million digits long every time, you can just set up your Face ID or whatever, and then you can access it like that. And there's a section, well, there's lots of bits on the app actually. They tell you what they think your income is, what the tax is that you've paid, but there is also a section that says estimated income, where HMRC are estimating your future income. So if your income has changed drastically, that's probably wrong, but you can go in and you can change it. And if you change it, it recalculates your tax and will send a new tax code out. So the app is really, really good. And that's what you need to be doing, is looking at, well, is that right? Is my income right? So even if you don't know if your tax code is right, you can check, is your income correct? This comes up quite a lot for people who have retired, because HMRC still think they're earning the same amount of salary, and now they've got a pension income as well. So initially people are being overtaxed. So really what we need to be doing is trying to keep on top of it so that we're being taxed the right amount as soon as possible. There's usually a month or so lag, but you don't want it to be anything more than that if you can help it. That's right. So so Robbie said that the tax code tells the employer how to deduct tax without divulging all your personal information to them. So your employer doesn't get to know your other sources of income. Exactly that. So remember, when we're dealing with data, GDPR, general data protection regulations, don't allow data about you to be shared all over the place. Okay. So your employer has the data about you that it needs to know. Your employer doesn't need to know what your other income is from somewhere else. They don't need to know that your pension income. because that's coming from the pension. They don't need to know what income you've got from a second job or a rental property or any investments you might have. They don't know any of that. So what happens is they tell HMRC what you've been paid, and HMRC look at that along with any other sources of income that have been declared to them, and they will determine the tax codes. So you can't expect your employer to know. Your employer acts on what HMRC tells them, as does the pension scheme and so on. Okay, so that's how the tax coding system works. Because what we must remember is we protect all of our data, and we don't want all of our data about all of everything we've ever done going backwards and forwards between people that don't need to know. Funnily enough, we're seeing loads on data today, but that's another story. So we know we've got a tax year from April to April. We know it's going to look at income across the whole year, and we know that tax codes are used. But how do we work out how much tax we're going to pay? What do they do? How does that work? So what I've got here is a chart. Now, if anyone's here from Scotland, please don't shout at me. The chart I've got is to show you the income tax rates or percentages for England, Wales and Northern Ireland. So if you were in Scotland, the percentages that I'm showing are a little bit different, okay? In fact, you've actually got an extra column. You have 5 columns, whereas we have 4. It's the same principle, okay? So it's more about understanding the principles rather than the specific percentages at this point. So tax works in thresholds, okay? Now that's really important to understand. So what it means is if we cross a line or we cross a threshold, we then don't suddenly pay a higher rate of tax on everything, because then nobody would ever do anything, would they? So what we normally have for straightforward circumstances is we have something called our personal allowance. And our personal allowance is the amount of money that we can earn without paying any income tax. And for most people, the standard allowance is 12,570. It can be less. The reasons it can be less might be because you're a very high earner, and that's when you start to lose some of your personal allowance. It might be because you've got certain benefits in kind which affect the personal allowance and things like that. But the standard allowance for most people is 12,570. So when I was talking about tax codes earlier, and I said most people have a tax code of 1257, you can see that's where the 1257 comes from, because that's saying this person has the standard personal allowance, and that's what all the numbers mean on the tax codes. So if my income in a year was £12,000, how much tax would I pay? Correct. Just checking you're all still with me. None, exactly, because I'm under that threshold, which is excellent news. Okay, so then we move on. When we then start earning over 12,570, we will then start to pay income tax. And the current threshold is anything kind of over 12,570 up to 50,270 is taxed at 20%. So I still get my 12,570 tax-free, but then anything from that point up to 50,270 is taxed at 20%. Does that make sense? I'm going to go with yes. And then if I'm very fortunate and I earn more again, so let's say I now earn more than 50,270, then anything over 50,270 is going to be taxed at 40%. Okay, so if I earn 50,271, that £1 that I am over will be taxed at 40%. I still get my 12,570 tax free, and anything from 12,570 up to 5270 is also tax free. Does that make sense? So we're always working in thresholds. So it's not if I suddenly earn £60,000, I suddenly pay 40% tax on all of my income. Now, the idea is because tax works in thresholds and in percentages, in the majority of cases, you'll always earn more, even if you pay more tax. Okay, because you're paying a percentage of something. So if I earn £1 more and it puts me in the 40% bracket, yes, I'll pay 40p tax on that instead of 20p, but I'm still getting 60p. Whereas if I didn't earn over that extra £1, I wouldn't get any of it. Does that make sense? So you're still going to be better off by earning a bit more and paying more tax overall. Now, that's not where it stops. There are mitigations and things we can do to manage our tax, but that's kind of the basic principle. The reason that's important is because one of the questions that I get a lot is, I don't want to take my pension at 60 because I will pay tax on it. And I'm like, but it's due at 60 and it's not backdated. Yeah, but I'm going to pay 40% tax on it. Okay, so your pension is £10,000 a year. Yeah, okay, so if you're going to pay 40% tax on it, how much are we going to get, everyone? See if our maths is any good this evening. £6,000, exactly. Perfect, Julie. So your pension is £10,000. We're going to pay 40% tax on it. We still get £6,000. Okay, excellent. So, but I don't want to take my pension because I don't want to pay 40% tax on it. So if I don't take my pension, I won't pay 40% tax. But how much pension do I get then? Very good. So we get no pension. So for me, in my head, £6,000 is more than nothing. That's just where I'm at with that. So we need to move away from paying tax is bad. There are mitigations. We're going to come on to that. But actually, if we end up paying more, then, that just means we've got more income. Okay, that's kind of what we've got to look at. Now, there is another tax threshold. I'm not going to dwell on this, in that if somebody earns over £100,000, then that personal allowance of 12,570 starts to disappear. So that's awful because that's like a 60% tax because they get the 20% and then the 40%. And also when you earn over £125,000, anything over the 125,000 is taxed at 45%. So we are very much in a tax regime. The more you earn, the more tax you pay. Okay, that is how it works. So I've just got a couple of examples. I'm going to run through them really fast. But again, it's mainly because you can take these away and look at them in your own time as well. Okay, but just to sort of illustrate what we've shown you there. So we've got a scenario where you earn £45,000 a year. We know we get 12,570 tax free, so we take that off. That tells us that the remaining 32,430 is going to be taxed. But because it's less, our total income is less than the 50,000, we're going to pay 20% tax on that 32,430, which is £6,846 a year. So you can see that there. We've got another example of somebody who's got two sources of income. So they've got salary of 38,000, they've got income from the pension of 22,000. That gives us a total of £60,000. So that's over the 5270. So we know some of that is going to drift into that 40% bracket. We get our standard allowance, so we can take that off. So we don't pay any tax on that bit. So we've got 47,430 on which we're going to pay tax. Anything between 12,500 and 50,000 is taxed at 20%. And then the remaining 9,730 is taxed at 40%. And you can see the breakdown at the bottom there of how much 20% tax is and how much 40% tax is, and therefore the total tax over the year. And that's how income tax works. Total income across the tax year based on the amount of income and those percentage thresholds that we looked at there. Any questions on that? It's quite a bit there to think about. But if we just understand the concept of it's a threshold, it's not a cliff edge, kind of makes it a bit better. Okay. Perfect. So how do we manage tax? Now, again, as I said right at the start of the session, we are not tax advisors. If you're somebody who's got a lot of income, lots of different sources of income, lots of different things going on, the basic principles are not necessarily going to be appropriate for you, and you will need to go outside and possibly look for accountancy or tax advice. So I'm just talking to you about some of the things that you can do. Does anybody know the difference between tax evasion and tax avoidance? Evasion is illegal, that's right. Yeah. So you've got evasion and avoidance. So avoidance is finding ways to reduce the amount of tax you pay legally. Evasion is where we're just not going to do it. However way we're going to look at it. So some people will have, certain illegal offshore accounts, or they'll file their accounts somewhere else, or they just don't pay it. That's evasion. You're evading it. Avoidance is actually legal. Avoidance is fine. Can anybody think of any examples of avoidance schemes that we probably use on quite a regular basis that we just didn't realise? I reckon Robbie's had his Weetabix today. Paying into the pension, exactly, because we get tax relief on the contributions that we pay in. Excellent, Anne. Salary sacrifice. That is also tax avoidance, because when you do is you do a salary sacrifice, it reduces your income tax and also your national insurance, actually. Yeah, so Claire says the washing uniform thing. So if anybody doesn't know this, if you wear a uniform for work, so I'm typically thinking nurses, but that's probably unfair because lots of people do, you can have a uniform allowance where you get tax relief on it. That's tax avoidance, but it's legitimate. Same with working from home. Robbie is a geek and studies boring books. Wouldn't say that. Professional subscriptions. ISAs, yes, to a point, yes. So you, with an ISA, it's you don't get tax relief on what you pay into an ISA, but any investment returns are protected from tax, and they're a scheme that's been set up by government a long time ago as quite a tax efficient way to save. We sometimes refer to them as a tax-free wrapper. So your money goes in after you've paid income tax on it, but then any investment returns you get are protected and are tax-free. So these are all tax avoidance schemes. Tax avoidance is fine. Tax evasion is not. Okay, so that's the thing we've got to remember. Avoidance good, evasion bad. Okay, so when I'm talking about managing tax, we're looking at avoidance. I'm not going to suggest you all like move out to the Cayman Islands. Efficiency does sound better, Sam. It's being efficient with our tax. So there are ways you can mitigate the tax. Tax avoidance is effectively a lever the government can use to incentivise us to do things it thinks is good for us. Exactly. So the pension is the best example of this. The government needs people to have their own pension provision because it can't prop everybody up in retirement. It's very, very expensive to do that. Now we have the state pension, but the state pension on its own, arguably isn't really enough. So they want to encourage people to do their own private savings. So how are they going to do that? How are we going to incentivize people to take some responsibility and accumulate some of their own pension wealth? And one of those things is the tax relief, because of those relief on the contributions, relief on the lump sum, and so on. So that makes it a really attractive proposition, and that's why they do it. Does also mean that they can change tax rules every now and then, but that's what they're trying to do. They want us to take responsibility. So it's an incentive to get us to save for our own retirement. So there are ways you can mitigate tax. As not a tax expert, I deal with people and tax all the time. And tax apparently is quite an emotive subject. We don't really like paying it sometimes. So when somebody thinks they're going to pay more tax, their initial response is, well, I don't want to. I'm not going to. And it's like, right, okay. Well, hence the example earlier. I'm not going to take the pension because I'll pay 40% tax on it. But sometimes what we're trying to save, we end up giving up more. So in that case of the £10,000 a year pension, we're trying to save 40% tax. Great. But we are giving up £6,000 a year net that we would receive. So you're actually giving up more than what you're trying to save. So we mustn't let the tax tail wag the dog. What we must do is just understand what our options are. So you could not take the income, and that might work in certain circumstances, but we need to really fully assess what that means. As we've already discussed, you can pay more into a pension. So some people, when they start drifting into the 40% tax bracket, they very much feel, well, actually, I would rather have the benefit of that instead. So what I'll do is I'll pay more into the pension and get that tax relief on those contributions. So again, paying more into a pension and taking responsibility and building up more pension savings is a really tax efficient way to do that. Charitable donations. So if you put charitable donations typically are the ones you put through on a self-assessment. If you put your charitable donations through your self-assessment, you can get tax relief on them. The gift aid thing is not giving you tax relief in the way that you might be thinking, Julia. But yeah, you only get the charity only gets the basic rate. That's right. You could earn less. I mean, that's an option, isn't it? Well, I don't want to pay 40% tax. Okay, we'll just earn less than 50,270 then. Oh, well, I'm not going to do that. Right. Well, so what exactly are we upset about? See what I mean? So there are ways in which you can take action to mitigate, but you need to be a bit careful about what it is that you're trying to do. Okay. So we've always got to be careful of what our objective is here. If your knee-jerk reaction is just, I don't want to pay the tax, it's like, okay, but, you know, it would be very much like, you know, again, coming back to that pension and income example, if I said to Robbie, hi, Robbie, you've done really, really great work. Thank you so much. I'm going to give you a £10,000 a year pay increase. Is Robbie, and I'll let you tell me, Robbie, is Robbie going to say, that's really kind of you, Laura, thank you, but I don't want that because I'm going to pay tax on it? Are you doing that? It's very fast at typing before and now it's gone quiet. I'm going to suggest he's not doing that. My circumstances are my notes. If you were a 50 grand a year earner, pretend that situation, Robbie. Yeah, so exactly. So you need to be, you know, you need to be aware of the situation. Okay, so you need to think about that. Usually people are not going to turn down a pay increase in those circumstances. Okay. I think Robbie's a more complicated, but you know, generally that's what we're doing. Okay. So again, let's look at our example that we talked about before, because I really want to hammer this to death because this comes up so many times. So I am a member of the NHS 1995 scheme. So my pension is payable from 60. Okay. Because I'm an active member, it's not going to be backdated. So that means for all the years I'm not claiming it, I potentially am missing out on pension income in my circumstance. I want to keep earning in my NHS role, so I want to carry on at work, but I don't want to take the pension because I will pay 40% tax on it. And this is such a common scenario. So this is exactly what we were saying before. So new figures, my salary is bang on the 40% threshold, so I'm paying 20% tax on my salary. My pension is £20,000, so I know that all of my pension income is going to be taxed at 40%. So if I don't take that pension, I'm missing out on £20,000 a year, or net £12,000 a year, because I don't want to pay 40% tax. It's madness, isn't it? So why would you do that? Nobody's doing that. Don't give away the money. Okay, so that's what we've got to really focus on, is what we're trying to achieve in terms of not wanting to pay tax, or just understanding how it works and why it is what it is. Any questions on this? Can you all kind of see that now? Can you see what's happening with the tax? Perfect. Right. So now I'm going to come on to some common questions, because I was trying to think how to do these slides, and I thought what I'm going to do is present you the questions that get asked a lot, because these are probably the things that you're thinking or that you might come across. I have covered, can I pay more into my pension in a bit more detail? What happens if I retire mid-tax year? How do I calculate my net income? How do HMRC deduct tax from more than one source of income? How can I check if it's right? Covered that one already, but we'll do it again. So, can I pay more into my pension? Yes, you can. So remember what we said, it's tax avoidance or tax efficiency, as Sam likes. We can pay more into our pension to get the maximum amount of tax relief we can. So what's quite common at the moment, because of this thing of people wanting to take their pension that's due at 60 and carry on working, is they look to be really efficient with it, and they look to pay more into their pension, because they then get the tax relief on it. And they don't necessarily need all of the pension income now because they're still earning, but they don't want to miss out on having that income by not taking it. So yeah, absolutely, you can pay more into a pension. Now, there are limits on how much we can pay into our pension. The first limit is we cannot pay more than 100% of our earned income up to £60,000. So if I earn £30,000 a year, I can't pay more than £30,000 into a pension. Okay. Now, pension income, so income that you're receiving from a pension, doesn't come into that. You can't include that. It's only income, what they call relevant earnings. Okay, so basic terms, it's what you've kind of earned through work. There is another limit called the annual allowance. Now, the annual allowance is very complicated. I'm not going to explain it on here, but it is something else that you do have to consider, particularly if you're looking at paying in a lot, or if you're a higher earner, then that can be another cap on the amount of tax-free pension savings you can have in a year. But the basic principle, yes, you can absolutely pay more into the pension. And the second basic principle is if you can pay more, then do, because of the tax relief. It's that super tax efficient way to save. You've got different options. You've got private pension, so that might be a SIP, a self-invested pension plan, or a personal pension. Just with those, your contributions are not being taken from payroll. So you don't get tax relief from payroll at source if you pay into a private pension. What happens is you get paid and you pay tax on the money you are paid. You then choose to put that money into a pension. So the government will automatically give you 20% tax relief back into your private pension. But if you're a higher rate taxpayer, you need to claim the extra back through self-assessment. So it's a little bit more admin that you need to be aware of. There are hundreds of thousands of people every year that don't claim back that additional tax relief because they don't realise that they should. Now, if you're just paying into your public sector scheme, it doesn't affect you like that because it's all dealt with through payroll. But if you're paying outside and you're a higher rate taxpayer, you will need to claim that extra rate of tax back. Within your schemes, you might have additional options. You might have an AVC. An AVC is an additional voluntary contribution. It's one of those defined contribution schemes we talked about at the start. So it's investment based. So you can haul your contributions in, you get your tax relief, it builds up in a fund or a pot of money, and then you can make flexible decisions about that. You can access that separately to your main public sector benefits as well. You can do something called added pension, or also in teachers, you also have the option, if there's anybody here from the teachers pension scheme, called faster accrual. So added pension and faster accrual, they're kind of similar things really. What they're doing is they're adding to the annual income that's building up. So you pay extra contributions and it means that your care or 2015 pension is going to be more per year when you come to take it. And again, if you pay monthly, it's dealt with through payroll, so you get the tax relief managed by payroll. If you want to pay for additional pension as a lump sum, you can do that as well, but you need to claim the tax relief back because it's usually managed differently, again, because you've already got that money that you're paying across rather than it coming from payroll. And then you could also do something called an ERBO, which is an early retirement reduction buyout for NHS. It's just referred to as buyout for teachers, or it is called an EPA, which is effective pension age for civil service, but it's all the same thing. It's just got different names. And what that does is you pay additional contributions in on a regular basis, again, deducted from payroll, so you get your tax relief at source. And it enables you to take your pension from your 2015 career average pension earlier with less or no reduction depending on the circumstances. So these are all options that are potentially available to you. If you use your pension scheme websites, you will be able to find more information about each of the specific options and what you need to do. And the schemes also have calculators on there that you can use. Okay. So we do a boosting benefits session. That's not what this is, but it's just to give you an idea of you can build up additional pension benefits and get that tax relief. Just be aware of what you're choosing, depending on what outcome you want. And also remember that there is that overall limits that we just touched upon there as well. So what happens if I retire mid-tax year? Okay. So the key message here is that tax isn't calculated separately for each source of income. It's calculated on your total income, and they kind of stuck it into those tax bands. So when I'm saying the tax bands, what I mean is those tax thresholds. So it will put income to 12,570, and then on top of that, you've got anything up to the 50,000, and then on top of that, you've got anything up to the 100 and 125. And that's what I mean by stacking it into the different levels. So if I have £20,000 worth of salary, and I carry on working and I'm still earning £20,000 worth of salary, and I've then got a pension income as well, which is £10,000, then HMRC will look at my total income in the year. Now, if I'm going halfway through the tax year, so let's say I'm going to start, the pension's going to kick in October, my income for the pension in the tax year isn't going to be £20,000 because that's the amount for the whole year. It's going to be half of that in my example. It's going to be 6 months. So it would be £10,000. So what they do is they look at your actual taxable income that you've earned in the tax year, and that's how they will determine how much tax you will pay. And therefore it depends on which, as we said before, with the thresholds where you sit as to how much tax you will pay. So when you retire in the tax year can be important. So for example, if my pension is going to be £12,000 a year, then we know that if that's my only income, I'm not going to pay any tax on that. We know that now. So that's what I'm budgeting against. So I'm budgeting I'm going to get £1,000 a month because I'm not paying tax on my pension income. But I've worked 6 months of the year and I've earned £20,000 in that 6 months. So what HMRC will say is, well, you've earned £20,000 and you're now going to have an £6,000 paid to you for the rest of the tax year. So therefore, that pension income that you're going to get is going to be taxed at 20% because of the other income that I've had. So I'm actually only going to get £800 a month until the new tax year. And then when the new tax year rolls round, because I haven't then got any other income other than my pension, I'm going to then only have £1,000 a month and I'm not going to pay any tax on it. So budgeting, particularly where you've got quite a tight budget to allow for changes in the tax year, is really important. And quite often some people think they're being overtaxed because their pension is of a certain level, but they hadn't appreciated that we've got to factor in what other income they've had in the tax year as well. And that's a really important part of the planning process. Hello, Karen. If you let HMRC know when you are retiring, will they sort it out correctly? No. So you can't tell HMRC about your income until you know what your income is. So you might know that you're going to retire in 6 months, but you don't know what your final pension figure is until they pay it to you. At that point, you liaise with HMRC. The pension scheme should already have done that, but you should obviously make sure that everything else is right, like your other income. So you can't tell HMRC in advance what your income is going to be. You have to tell them as it's happened. So even if you've had an estimate and you know what the pension is going to be, until you get that first pension payment, you can't liaise with HMRC, because what if it's paid late? What if, for example, you thought you were going to get your first pension payment in February, but it's not paid until April? That's in a new tax year. So you have to wait till you've actually got it into payment, and then you know the exact amount, and you also know when it comes to you. So it's really important that you keep on top of it as and when it happens. So you can't tell them in advance. And actually, it's the pension scheme in respect to pension liaises with HMRC, or your employer in respect to employment income also liaises with HMRC. We've got something called RTI, which is real-time information. So like in my business, when we run payroll, it sends an automatic feed of information to HMRC. HMRC continually assess that every time we send a feed, and then will tell us if a tax code needs to change depending on other people's circumstances and so on. So they're not they initially will take the information from your employers, but obviously you can update that if it is incorrect. And your employer can't change a tax code because you tell them. They can only operate on instructions from HMRC. So if your tax code is wrong, it's because that's what your employer has been told to use. So they need to wait until HMRC tells them about the change. This is where it's helpful to understand UK income tax. HMRC by default will probably give you a tax-free full allowance to your... I'm coming to that, Robbie. Right. Baldi, I expect civil service pensions will not pay me until after the new tax year and include 5 months back pay. Will I be put in a higher tax band? Yes, that is a potential thing that does happen. So when anything's back paid, so for example, if you get paid in May, and you've got 6 months worth of pension payments in there as an arrears, then yes, normally what HMRC do is they tax you in the tax year that you receive the income. However, there's something called smoothing that very few people know about. And if you can evidence to HMRC with information from the pension scheme, in this case, that it should have been backdated, HMRC will smooth the tax. So the rate of tax applied will be the rate that it should have been had it been paid at the right time. You can also do that with backdated pay. So if you get backdated pay across the tax year, and you therefore think you're paying too much tax on the arrears, you can also get that smoothed with information from your employer and you going to HMRC. Okay, so you can apply for smoothing in that circumstance, and they will do that for you because it's not something that you can control. So we've got a question about redundancy. What if I'm made redundant and receive a redundancy lump sum and take the pension also? Okay, so redundancy works a little bit differently, but let's talk about that because it's very topical at the moment. Redundancy payments are different sorts of payments, and the tax rules allow for the first 30,000 of any redundancy payment to be paid tax-free. So that's ring-fenced and is tax-free. So if my redundancy payment was £60,000, £30,000 of it I don't pay any tax on. I just get that. Nice. The other £30,000 though, anything over the first 30,000, it is taxable. And the rate of tax you will pay is your marginal rate of income tax. So that in my case, in my example, they would take that additional 30,000, add it to any income I've had or in the tax year. So that could be pension income, it could be employment income and so on, and they will work out the rate of tax that I pay on that. If I then take my pension as well, then my pension might then all be subject to 40% tax in that year because I've had that redundancy payment. So redundancy payments as well, where they're quite big because public sector, I'm going to say it because I'm a private sector person, public sector redundancy payments are quite big. You get quite a lot of enhanced redundancy payments. So quite understandably, they can tip you into very high tax brackets because of the amount that you're receiving. So if you then take your pension as well in that tax year, your pension could all be subject to masses of tax just in that year because of the redundancy payment. Does that make sense, Bevy? Claire, I'm partially retiring and dropping hours so that my total income will stay the same. Will HMRC assume that I'm staying on my current hours and tax me more? So again, I'll just repeat what I said before, Claire. They take the information given to you by your employer. So it's quite possible in the first month that you partially retire, they will have it wrong. They will assume the previous rate of salary and the pension income. So it's quite possible that in the first month you might be overtaxed. But then they catch up and then they get another feed that says, oh no, your employment income is lower. So then they will try and make an adjustment. That's what they should be doing. But this is where you can check the app. So once the partial retirement's happened and you've been paid and your pension payment has kicked in, go on to your HMRC app, look at your estimated income. If your estimated income is still showing your salary as being the full rate of salary before you were partially retired, you can change it to what it will be now. But be careful because although you might now be on less hours, there was a period of time you were still on the full hours. So you need to make sure you work it out, pretty much bob on. So you might have done 6 months at full time and now you're doing 6 months at half time, for example. You'll need to make sure it reflects that. Don't reduce the whole estimated income to half time because then you're going to underpay tax and then next year they're going to want to tax you more. So just be aware of that. Remember, it's total income in the tax year. Right, Karen, would it be better to retire at the end of the tax year? So it depends on the circumstances. If you are retiring in full and you're a high rate taxpayer and you're very tight budgeting and you haven't yet reached your normal pension age, then it might be worth thinking about going at the end of the tax year to keep it kind of a lot more straightforward. But if you're still working and retiring, and you're at your normal pension age, then overall, you might be better off by still taking the pension mid-tax year. Kind of got to weigh up those different scenarios that we looked at. So we might pay 40% tax on our pension, but at least we're getting our pension. But if we don't claim it and it's due, then we're missing out on it. So it's just trying to weigh up all of those things. Hi, Wendy. How do you arrange to pay more pension contributions from your salary? And is it right to assume that NHS won't pay their extra contribution over and above what you're already paying? That does make sense. No, your employer won't pay any more. And the reason your employer won't pay any more is because they already pay an enormous amount. I don't know if you were here at the start, Wendy, but they already pay upwards of 23%. So they pay an enormous amount. So if my salary is £35,000 a year, let's call it that, then they will pay, say, 25%-ish. They will pay £8,750. So therefore, it's not costing them £35,000 a year to employ me. It's costing them £35,000 a year plus 8,750, which is nearly £44,000. So no, they're not going to pay any extra if you pay extra because they already pay in an enormous amount. Now, if you want to pay extra, you need to go onto your pension scheme website. So Google NHS pension additional contributions, it brings up all the information that you need on the pension scheme website. Cannot stress enough how much you must use your pension scheme websites. They replace guides. You know, we used to get hard copy scheme guides, you know, back in the day. Well, we don't get those anymore because it's all online. But if you go on there, there's calculators and then there's forms to fill in and there's processes to tell you what you need to do to pay the extra contributions. The specific process depends on which scheme you're in and how you want to pay your additional contributions. But everything you need is on the website. Hello, Sam. How do you work out estimated income as what is shown on my payslip is before pension? Just take off the percentage that would be paid. So yeah, Sam, it depends on where you work. So if you work in an NHS trust, on your payslips at the bottom, you've got taxable income and it's the accumulative amount. So if you looked at the March payslip, for example, it would show you the taxable income that you'd had for the tax year. So it's already taken the pension contributions off. If you don't work for an NHS trust, then you might not have the cumulative taxable figures, but most should do. Most should have that on there. You can also ask payroll. Payroll can tell you. But essentially, yeah, it's your income minus your pension scheme contributions. You are more than welcome, Sam. Okay, Sam. So if you're in the NHS and you're in an NHS trust, you should have. You might have. Have you got March's payslip yet? You'll have February's payslip. Have a look at the bottom. It's got the cumulative figures for the tax year at the bottom. So if you've got February's, it'll only be up to February. You'll have to add on another month, but it'll give you an idea then so that you can see what that is. And then every year your employer produces a P60 for you, and that tells you your taxable income that you had in the last tax year. Okay, are we all right there? Shall we move on to the next question? How do I calculate my net income? So I did a thing, look, with a screenshot. This comes up quite a lot. So we know everything that we get from the pension scheme is gross. So if they're going to tell me that my pension is £20,000 a year, that's before any tax is deducted. And the reason for that is because the pension scheme doesn't know how much tax I'm going to pay. Probably don't know how much tax I'm going to pay because it depends on when I go in the tax year, what other income I've got, what other income I've had, and so on. So they can't do that. There are calculators you can use online, and I've put a link to one here that we like quite a lot. We're not affiliated with it in any way, and we can't take responsibility for the external links. You can find others. But this is quite nice because it also has a 2 jobs option. And within that 2 jobs option, it gives you the option to make one of them a pension. So you tick and go, my second job is a pension. And the reason that's important is because we do not pay national insurance contributions on our pension income. So we don't want it to treat it like salary. We want to treat it like a pension. So there's lots of online resources you can use, but really what you need to know is how much am I going to get after deductions, and you can use these online calculators to do that. How do HMRC deduct tax where there is more than one income? So what they normally do, somebody's going to refute this with me in a second because sometimes they're a bit random, but what they normally do is look at the main income. Okay, so if my income from my salary is £30,000 a year and my second income is pension and it's £10,000 a year, they will usually put all of my personal allowance, remember that's my tax-free amount, against the salary. So they'll put the 12,570 against the salary. So that will reduce how much tax I'm paying on the salary. I'll pay 20% on anything over the 12,570. That means then that my pension, because it's the lower income out of the 2, doesn't get any personal allowance because that's already been used up with salary. And so all of my pension will be taxed at 20%, which might mean it's a BR tax code, which is basic rate, because so it's all going to get taxed at 20%. So I've still had the personal allowance, it's just been all allocated to one of the incomes, and then the other one gets taxed in full. You can choose to change it, you can choose to swap it around. It doesn't make any difference to your net income. Your net overall income is going to be the same, but you do have the option to switch it around. So if your pension was the highest income, it's likely that they would allocate the personal allowance eventually to the pension, and then all of your salary would be subject to tax. So yeah, just be aware you can change it, but that's usually how they would set it up. But as I say, sometimes they do random things. So again, just be aware if you think, oh, hang on a minute, I'm paying all the tax on my pension, check what you're paying on your salary, because that might be why. Lots of people often think it's incorrect. It's because they haven't appreciated that the tax-free bit has gone against the salary. Does that make sense? Yeah, okay. And then how can you check if it's right? So we talked about this already, and I'm quite happy to talk about it for another 27 minutes if we need to, and we're not staying 27 minutes. Use your HMRC app. The app is really, really good. And you can actually use it for lots of things. You can actually use it to check your national insurance history. You can use it to check your child benefit. You can choose it to check any other benefits, past submissions, past tax, estimated income, and so on. I mean, estimated income is the one that you want. You can use it to check your state pension. So the app is really, really good, and it's actually super easy to use once you've done that initial download and log in with your 12-digit .gov gateway, blah blah blah. But it's very, very good, and it really is the place to go. And you might have seen this week, I did a post on the Facebook group that says, I am not HMRC. I get a lot of questions about, well, I think I'm being taxed too much. Why has my pension gone down when it was this? And I'm like, I'm not taxed. I can answer. And my answer will generally be, have a look on the app, because that is where you will need to go. So when pension amounts change, we need to understand, has the pension itself changed, or is it because tax has changed? And again, the HMRC app is a good place to go because it will show you the income that's been paid to you and the tax that's been deducted. So if your pension was £1,000 a month, and this month you get £800, you can go onto the app, and the app will show you, yes, you actually did get paid £1,000, so we know the pension hasn't changed, but we took 200 quid off you in tax. Okay, so that's what's happened. And you can see that by looking at the app. So all we've got to do is invest a little bit of time in getting to know how the tax system works. And the more that we know that, the more we'll understand what's happened. Okay, you can, of course, ring HMRC. I don't know if you've tried that. Can take a while, probably sit down with a cup of tea and a biscuit, but the app is kind of pretty instant. You can kind of get into stuff really fast that way, and it means we haven't got that kind of waiting around on the phone as well, listening to that terrible hold music. So do use the app if you can. Okay, so it'll help you enormously. And then I'm stood here talking to you about your pension income and tax, but this is about tax in general, really. So with your salary, you're paying tax. Do you understand why you're paying tax? Do you understand how much tax you're paying? Do you understand what all the thresholds mean? Because it affects that as well. And as I say, they never teach it to us at school. We are naturally quite lazy with it because we don't need to do anything, because it's all done for us through the PAYE system. So have a think about those kind of things, okay? Just to see what looks right for you. So they were the main questions I was going to talk about. Does anybody have any questions that we haven't covered, or has anything got anything burning that they're really anxious about or not sure? And while you are all furiously typing, at the back of the slides, we've got some useful resources. So I've got the link to where you go if you want to download the app. So when you get the slides, these are links, so you can click on them. There's that income calculator that we talked about. I haven't put the pension scheme websites on there because you're all in different schemes, but you can just use Google. Google is your friend. Google NHS pensions, Google civil service pensions, and you'll be able to find what you need. And then also for pay slips, you should look at your pay slips periodically to check your contributions are coming out, that they're coming out at the right rate, and so on. And you should be able to get that through your payroll system. So that might be ESR if you're in the NHS, or it could be some other system depending on where else you are as well. But make sure you can get access to all of those as well, and do check your pay slips. Questions. Carol, what other income will be added to your pension for tax purposes, such as benefits? So some benefits are taxable, Carol, some are not. So PIP, for example, is not. But some are, so it depends very much on what they are. So if you are in receipt of benefits and you want to know if they're taxable, again, the best thing to do is go onto the .gov website, and it gives you a list actually of these benefits are not taxable and these benefits are. State pension is taxable. So state pension is added to your income when it comes in, and that obviously pretty much uses up all of your personal allowance. So yeah, it just depends on the benefits. There's kind of a bit of a split there. Other income obviously is earnings, income through rental, investment income, returns over a certain amount you pay tax on, they are also added on. Other income like inheritance and capital gains tax is separate, so you don't need to worry too much about that. That's dealt with separately. Hello, Wendy. Just want to say thank you. Oh, you are more than welcome. Claire, hello, Claire. Sorry. My earlier question about the 25% tax-free amount of pension, including lump sum, is it the figure on the pension that's called hypothetical annuity cost? Sadly, not, Claire. So the hypothetical annuity cost, the key word there is hypothetical. It's basically a made-up number with a degree of logic to it, in that it's trying to show you how much money you would need to have in one of those other pensions, the defined contribution pot, if you had that instead. So how much money you would need to have to replicate the NHS pension benefits. So remember, it's on the total reward statement for those of you in the NHS. So it's trying to show you the value of something. That's all it's doing. In order to work out the 25% tax-free lump sum and that capital value, what we do is we take the annual pension, we multiply it by 20, we add on any lump sum, standard lump sum, and it's 25% of that. That's how we get to that number there or thereabouts. It fluctuates a bit, but that's just to give you an idea. Boosting benefits, yes, Sue, but I think they are on the member zone subscription. So you can join our member zone. That's only for NHS pensions members at the moment. And there's extra webinars and specialist subject ones, and also loads and loads of content that talk about things in the way that I talk. So English, as opposed to pensionese, and less jargon. And we do the boosting benefits ones on the member zone. I'm not sure when the next one is, so I think it's later this year. Oh, you did the consultation meeting and it was excellent. Oh, thanks, Julia. That's good to know. You are all welcome. Sorry, I'm just looking for questions. Since I took partial retirement in January, my tax code has been K. HMRC kept saying, oh, I know what I need to do now. I think they think you earn more than you do, Catherine. That is what I think. Annual pension times 20 plus the lump sum. Yeah, Claire, that gives you the capital value. And then 25% of that amount is your 25% lump sum or thereabouts. You are more welcome. Can I do a session on pension recycling and avoiding possibility of exceeding thresholds on increased contributions? Maybe, Sam. It depends on demand. Let me have a think about it. Okay. The questions are paused for a second. Okay, here is the services that, so sometimes I have to charge for things because, you know, I'm a business and I employ people, so it's really bad to not charge for things. So sometimes I do. These are some of the services that we provide. You can find them all on our website, but they range enormously in cost depending on what you want. So we can do a form filling meeting, consultation meetings, all the way up to pension modelling. This is the most popular one, this pink one here. And that's where we would sit down and work out your numbers for you, work out both McLeod options, what your tax-free lump sum options could be, what about if you've got this income, what about if you've got that income, what does that mean, what does, you know, what happens if you reduce your hours now, what does that do to the pension, what about if you take this bit now and this bit at 67, all those different things comes under the pension modelling, and we do a big report for you and with all your own specific numbers, and then we have a meeting on Teams to go through that with you. So they are very popular. Obviously lots of McLeod stuff in there as well. So do have a look. Use a lot of the resources that your pension scheme website is free. So use that as well. Can you do a session, as I don't understand option A and option B? Right, Debbie, there is one that I ran and it's on the website. The link to it is on the website, I think. Bear with me. Because I recorded it, like I'm recording this one. So let me just check for you before I start telling you things that aren't true. Yes, so on our main website, Pen-gage website /webinars, I'll put it in the chat, hang on. There is the pre-recorded webinars that we have done previously. And the third one down is the 2025 total reward statement, which talks about both options. So that is also me. It's about an hour and 10 minutes. Obviously, you don't have to watch it all, but that explains what the two options are and why we have them. If you are in SPPA, then the webinar underneath that explains your statement as well. That is 1 hour, 11 minutes. So you've got an extra minute of my time. Appreciate that. So have a look at that as well. Because there's a few different ones on there. So some of these do exist if you search for them. Claire's a member of Member Zone. Excellent. So Member Zone, if anybody doesn't know, and you're still here and you haven't all left, is a subscription service. It's a web-based support. But it's got access to specific webinars like ill health, boosting benefits, partial retirement, financially planning in retirement. You get access to the recordings and the live sessions. We've got videos as well explaining lots of different things, how to interpret the TRS. It's got pension benefit calculators, including pension input amount for annual allowance. It's got ill health retirement, excuse me, calculator. It's got guides on how to fill in your forms, how to interpret statements, what everything means. So that is a subscription. You have to subscribe for 12 months. So you can pay one-off fee for 12 months for £100, or you can pay £8.50 per month, but you must continue for the full 12 months. And you can continue beyond that if you want to. But all those resources are available on Member Zone. So we've tried to cater for different learning styles, things that work differently for different people, but also different price points as well. So give you kind of all those different access. So do have a look at that. I love you too, Sam. Thanks. I'm going to turn off the recording. So thank you everyone who is watching recording.